Good morning and welcome back to day 2 of our public meeting for the Private Company Council for December of 25. Thanks you guys for all coming back again. We have our Christmas crowd over here on the side, color coordinated from yesterday, which is hard to do when one of them travels, but it worked out fine. And now we're on to topic 6 that Ashley's going to lead us through. And one thing I want you to keep in mind around the SAC and the debt disclosures is would love to put ourselves in a position after today to think that in the March meeting we could quote unquote do something with these. So this could let's try and make these as substantive as possible so that the staff will know whether or not that's an achievable goal or whether there's more work to be done. So with that, Ashley, take it away.
All right, thanks, Trey. Good morning, everyone. As a reminder, at the September meeting, PCC members provided their preliminary views on various aspects of the guidance involving subjective acceleration clauses, or SACs as I will refer to them, and requested that the staff conduct additional outreach with users and other private company stakeholders. Since that meeting, the staff has conducted outreach with practitioners, preparers, and users. This included outreach meetings with 7 stakeholder groups, 6 of which were summarized in your meeting materials. Additionally, the staff had 5 outreach meetings with practitioners last week and held a 7th stakeholder group meeting this past Tuesday. Because this outreach was not included in your meeting materials, I will provide a summary of that feedback, starting first with the practitioner outreach from last week. These practitioners observed that questions around the application of the guidance on SACs do not often rise to national office teams, aside from occasionally in going concern assessments. However, they indicated that SACs are very common in debt agreements and may often be overlooked, and that the guidance may not be well understood and applied. They indicated that, to their knowledge, lenders rarely, if ever, accelerate debt based on SACs alone. And they also noted that it is rare in practice for an entity to enter into a financing agreement to demonstrate its intent and ability to refinance short-term debt on a long-term basis. And rather, if a company is trying to achieve long-term classification, they will actually execute a new loan agreement. As it relates to cross-default provisions, they noted that these are common in debt agreements. However, there was a general consensus that entities may not be fully contemplating how instruments might be interrelated. The practitioners indicated that while the debt classification guidance as a whole is patchworked and complex, they do not think that significant time is being spent by preparers or auditors in applying the guidance around SACs. All practitioners supported the research being done by the PCC, but would not consider SACs to be a high priority project. Several of these practitioners indicated a preference for a broader project on debt classification and cautioned against any changes that would be inconsistent with other areas of the guidance. Generally, practitioners were supportive of the PCC's preliminary observations involving the removal of the probability assessment in favor of a trigger-based threshold, but a few observations were raised. 2 practitioners asked how a trigger-based model would interact with the subsequent events guidance and suggested including application guidance or examples in the codification. 1 practitioner was supportive of a trigger-based threshold for long-term debt, but raised some conceptual consistency concerns with short-term debt being contemplated for long-term classification, such as arrangements with lockbox requirements in SACs and financing agreements with SACs when demonstrating intent and ability to refinance, because with the existence of that SAC, it would be difficult to say that there is a firm commitment from a lender to extend the debt. Most of the practitioners were generally supportive of defining trigger as when a lender demands repayment. 1 practitioner encouraged the PCC to think about whether this would need to be a formal written demand or if an informal or verbal demand would also constitute a trigger. Another practitioner questioned whether a demand for repayment is legally enforceable, and instead a trigger should just be once repayment has actually occurred. And another practitioner noted that a lender's notice of noncompliance with a reservation of rights should also constitute a trigger, but observed that this may not actually occur in practice. And lastly, all practitioners indicated a preference for any changes considered by the PCC to be extended to all entities, including public companies. During the stakeholder group meeting with practitioners on Tuesday, one of the practitioners noted that SACs and lockboxes are very common among small private company clients in the construction, real estate, manufacturing, and distribution industries. However, they noted it is uncommon for lenders to accelerate payment based on these clauses, but that they have seen lenders use SACs to invoke default interest rates. Some practitioners agreed that a trigger-based assessment would reduce subjectivity. 1 practitioner questioned how a trigger-based model would interact with the subsequent events guidance. These practitioners had mixed views on the direction of a debt disclosures project. One noted that users of private company financial statements are typically the lenders themselves, and therefore more disclosures are not necessary, while others noted that more disclosures around events of default would provide users with more decision useful information. So with that, we'd like to start with questions 1 and 2 in the memo, which ask whether PCC members have questions or comments on outreach activities that have taken place and whether PCC members want to revisit any areas for which preliminary observations were provided in September, including on the probability assessment, description of a trigger, the intent and ability to refinance, and revolving credit agreements. With that, I'll open it up for questions 1 and 2.
Mr. Hoagland.
Ashley, thanks for that. The lot there, a lot of speculation about lenders. So I guess as a lender, I can speak a little bit to it. True, we tend to be lenders to the private companies, but a lot of times they have multiple lenders. So understanding what the other lenders around disclosures and defaults would be important. I think it's really about acceleration. If you don't deliver financial statements timely, we can send you a reservation of rights. That's not really getting to acceleration of the debt. And so not sure going down that road makes a lot of sense. Some of the things we've talked about, I think, previously would kind of lead us back to there. So there was a few comments in there I don't necessarily agree with, but I think we've kind of talked about those at length. So just leave it at that.
Thanks, David.
Yeah, just curious. I hear that these are not as common as maybe we thought when we started. But I guess the thing that I still puzzle over is there's a difference between someone saying we won't call the debt because we're better off not, versus they have a legal right to call the debt. And I just want to poke on that a little more. When it comes to subjective acceleration clauses, is the PCC considering this, assuming that because that's in an agreement and it's a right that the lender has put in the agreement, that it is substantive? And we're really just trying to evaluate when we should take that substantive criteria into account for classification. I just want to come back to that because I heard a lot about, well, lenders won't do this because it puts them in a worse position, but it might be the same thing on the late financial statements, right? They may not, even though that's a covenant violation, they may not want to call the debt because they may not get as much money. To me, that's different than they don't have the right to call it. So I just wanted to go back to that and make sure I'm clear on, do we think substantive acceleration clauses are legally binding and substantive in the agreements, or are we looking at them differently?
Well, I'll give you my opinion about what I think we think about that. Is that as an auditor, and quite honestly, I thought almost all my clients had clauses like this. So when people say they don't have them, I'm always kind of shocked. I'd like to read the agreement myself because I think every bank puts them in almost every loan agreement. Because why wouldn't you? I mean, I think the challenge that it creates for preparers, and unfortunately driven by their auditors often, is requiring them to assess, has anything happened in your organization where this might be triggered? So yes, it might be legally there, but I think our experience says is that we're making people do a probability assessment that, from our feedback from most lenders, in and of itself, they never execute. So we're making a company in their own situation do a proportional evaluation of whether this clause alone creates a callable event.
So said another way, we're not challenging whether it is legally binding. We are simply saying it's difficult to evaluate.
I would say impossible to evaluate.
I understand.
Yeah, I would just say that in practice, right, like we wait for a financial covenant or something more, so we get guidance from our counsel that we're not going to, a lot of these came up when you provide potential future financings, right? Like you're committing to an IPO financing, and the world has changed. And so in that situation where we haven't funded anything, we would probably be trying to, so-called wiggle out of that, right, in some way. So we might use that. If you're in the existing deal, I think you cause a lot of, certainly disruption, and it's harder to do that. But I would say, if we go talk to council, 9 times out of 10, it's wait for the maturity date, wait for a covenant default where you have a little bit more specificity around, the subjectivity of it.
Adam?
To that point, and I don't know if I'm going to phrase this as a question, but I mean it as a question. So maybe someone can confirm or deny. My understanding going into this is that these alone are not particularly substantive, that they don't hold up in court by themselves, that it's a clause, but I don't think I've heard from the feedback that this clause alone makes a difference. And then I did want to confirm, I think they are very prevalent. They're in almost every single agreement. What's not prevalent is a lot of people and professionals don't recognize them and don't understand that they have other extra accounting treatment, so they're not always caught, but they're in a lot of agreements.
Yeah. Can I just, the reason I asked is I always find it a little bothersome when we say that there's this provision in an agreement that a lender won't do without that provision in there. And then we're going to, for accounting's sake, ignore it. And I don't think that's what you're saying. That's why I went back to, I think there's a big difference between saying there's this provision that has to go in every agreement that the PCC would say ignore it for accounting purposes versus it's in there. We're not questioning whether or not it's valid. What we're doing is we're evaluating, how do you evaluate it and when should it affect the classification?
Yeah, because it's difficult to figure out the probability assessment, and it's very seldom is it that clause alone. I don't think we should ignore it. I think it should be disclosed. If we wanted to go down that path, that's certainly there. But to put management and the auditor in the position to try to understand probability of this particular clause and driving classification of debt on its own it's too much.
Well, and I think, again, the people who do know they're there and know that something needs to be done about it or believe something needs to be done about it, it does create cost for the preparer, because the auditor then, have you had or have you not? And then we want some sort of certification from your lender that they aren't or they won't, which they never will provide, because they're not going to say they're never going to enforce that clause. So I think the problem is the subjectivity of this is so hard that people don't, they choose to ignore it in the belief that isn't going to happen anyway, as opposed to disclosing it so the user can contemplate on their own whether or not there's an issue they need to be concerned about. Robert?
Yeah, I think the outreach was very effective, and I think this has been pretty well understood. I think we've done a lot of work here, and I appreciate the staff's efforts. I know in my long career, this has been in every loan document that I've ever executed, and we've never accelerated, but we've certainly negotiated and horse traded because of it. So typically, it's my experience, these are used as an opportunity to negotiate a deal that may be off the rails just a little bit. So I think they're there. I think the probability assessment would be extremely difficult to ever do. But I do think if the lender demands, this should change the classification, because who knows what the courts will do. That would be very fact dependent, and there's not tried very often because I think the negotiation works. So I think the trigger based is the most reasonable, but I do think if it's demanded, it does need to become a current liability.
Mike?
Yeah, just to confirm, I don't think I've ever seen a debt agreement that does not have a material adverse clause. They're not called SACs or subjective acceleration clauses. That wouldn't make sense. But I think I had the same question yesterday of, in our outreach or in our discussions with any lender, has this ever been enforced in a court of law where there's no other covenants breached, but based on a subjective or material adverse event, that they call this debt and they successfully collect cash. And I think that's been a no. So I don't know why we spend so much time on a provision that does not sound substantive. I know it's in the debt agreements, but historically it has never really landed in a position where it became current because of that one provision. I just think in reality, you're going to probably breach other covenants before you get there. So,
Thank you. Hillary?
I think the question of whether it's substantive, I think it's in the agreement, right? I think this is not, I see a lot of parallels between this and other questions we get with regards to our debt equity guidance of provisions that are within those agreements that may not be likely to occur, but are driving an accounting result of something, for example, being debt rather than equity. I see a lot of the same parallels here. But with subjective acceleration clauses, I do think we've gotten feedback in those other projects of, well, there's a very remote chance of that occurring. And it feels similar here of a remote chance of occurring, or we don't necessarily have the ability to tell you what that probability will be. So just let us account for it when that event does occur. Like when it does occur, obviously that could change the debt classification. I don't see that much different than a lot of the feedback that I think we'll be taking on, looking at from agenda consultation on debt versus equity of whether or not classification should change based on it. I see a lot of the same parallels here. So just certainly, something I wanted to highlight of some consistency perhaps in the feedback that we're hearing.
Thanks, Hillary. Doug?
Yeah, I'd echo a lot of the sentiments already stated. So just to assert my belief, I think the probability assessment, I completely agree, is extremely difficult in practice to apply. I think where I would like some more clarification, particularly Jerry, to your opening comments about hopefully getting us towards a substantive potential solution here, is around really the definition of the trigger, and maybe the users in the room can help me, because I think we're saying the probability assessment is really difficult to do because of the nature of the subjective acceleration clause and when they're tricked or tripped up. Robert, I think your comments a second ago helped even further clarify this, is those clauses are oftentimes used as a way for lenders to have something to negotiate with, like, hey, this is on the table now, we need to adjust the terms, and maybe it ends up, lending itself to an amendment to the agreement or whatever. And so I think what I feel like I've heard is it's when that demand letter comes, that is the trigger, and that's when the debt would be reclassified. I do anticipate, though, that there's probably, and I feel like we probably addressed this in previous sessions, but it's probably not the subjective acceleration clause is tripped, and then there's this notice of demand. There's probably an initial notice. It's like, we feel like you're out of compliance. And then there's probably some discussion back and forth. And I guess would we say, and I think this is where some of the feedback came, is the trigger when there's this subjective acceleration clause has been tripped and now we're moving into this more of a negotiation phase? Or is it really when the lender is saying, no, we're calling this and we're demanding it now? The reason I ask that question is I feel like if we were to make standard setting adjustments, that definition of the trigger event will be critical. And I feel like there's probably diversity in practice in terms of how lenders notify their borrowers in events when there is a triggering event. And so just making sure there's clarity in whatever we put on, like, what that trigger is. And so that would be maybe where I'd like to understand a little bit more. Is there a lot of diversity in this space? And do we fear or risk that if we try to define the trigger that we don't do it successfully and we still find scenarios where, do we classify this as current or not? Because it's maybe not as clear as we would otherwise intend. So that would be the only thing I'd like us to maybe talk a little more about or help me understand.
Thanks, Doug. And up is David Hoagland.
So hopefully I can address some of Doug's questions. But first of all, I guess I turn it a little bit on its head. As a user of financial statements or as a lender to a company, having the accounting profession, I guess, decide when one of these should be invoked is a little concerning, because now all of a sudden, I'm sitting in front of or behind some bonds, and all of a sudden in the agreement, you've decided they're in default of some agreement. And now that has, certainly taken the leverage from my position. We may not agree that they're in default, but yet now we've got to deal with that, right? And we have quote unquote opinion from someone who doesn't do this every day, deciding that the company's in default, and then that, all of a sudden starts a clock or a process that isn't super comfortable. Doesn't happen a lot in practice. What happens is we get a call and say, well, our auditors or whoever think we're in default. Can you tell them we're not? Right. And so we try to craft something or do something that waives that, right, in some short period of time, right? So it puts everyone in a very tough spot because someone who is not trained in what we do, credit analysis, right, they're making a subjective decision based on some probability model, I guess. So that's, doesn't seem to make a lot of sense from a user or a lender's standpoint. I guess to Doug's point, I think he's right. We go through a process, right? The first one can be verbal, right? Hey, we think you're in default of this subjective clause. We could then, they don't see it and we feel good enough about it, but we still think, and we put that in writing, right? That's kind of a reservation of rights, for lack of a better word, but that's how we would do it. Then there would be, if we get to it, a default notice, and then there's cure periods. Usually things like this have a 30, 45, 90-day cure period, right? So you got to get past the cure period. So the guidance would have to have some of those elements, right? Like, I guess you could, if you wanted to be conservative, you could say, hey, if you've gotten any verbal notice of any of these, right, like, then maybe an auditor says, well, now it's just a matter of time, right, that you're ultimately going to go past all of these dates, right? And if you don't get me some sort of waiver, then we're going to put it in our agreement. So I do think there is a trail that we can follow, or a path that we can follow, thinking about what those cure periods might be, and how to craft something like this for sure.
Yeah, I think that makes a lot of sense. And that's just where I see the stickiness of defining this trigger. And I think Adam even said in his comments about the need to disclose subjective acceleration clauses. And I feel like I even saw in some of the user feedback or stakeholder feedback that even just because, to all of our points, these show up in almost every agreement. Is it even substantive to put a disclosure like, yep, we have this clause in there? So it's really, should you only disclose it if there's something that's happened that would trigger that? And so as I was even hearing you, it's like, maybe it's like when that verbal communication happens, that's the disclosure trigger. And it's almost like the contingencies guidance. And then it's like when you get to a point, maybe then the written thing comes in or whatever. And I think we all agree once that demand notice is received, there's no argument at that point. It's current and you need to, but that starts to feel sticky if we're trying to address this in standard setting of when do we sort of draw those lines and how do we clarify that? So,
Sue?
So maybe just to follow up on that, because I was kind of thinking about, generally speaking, right, when a company violates a debt covenant, there's a disclosure about it. And so I wonder if that's as important. I mean, these sort of nuanced, the verbal, the reservation of rights, all this, the rest of it, is that as important in a disclosure as it is that they, for you assessing maybe a loan from another lender, that they violated their debt covenants? Do you see what I'm saying? So like the trigger would be obviously a clear disclosure and maybe a presentation change, but that intervening period is the disclosure of a debt covenant violation in itself enough? Maybe that's a question for Dave.
Well, I think what we run into when we talk to the people when we're verbalizing this is, I think people forget that this isn't about whether a mathematical covenant was violated, because that would be clear. That is, people may agree or disagree as to whether it's been violated, but that is not subjective. That is measurable. And I think it's hard to say that this is a covenant violation because that's not the part of the agreement it's normally in. It's normally somewhere else.
Well, oftentimes, though, that's a piece of it, right?
Correct. This subjective piece is because I think the clarity
Meaning
is
you violated the covenant and they have the ability to
correct.
call it. So
In the probable possible remote, I know that maybe those aren't great terms in the current age, but nonetheless, that perhaps the notification of rights letter on a subjective clause is the possible.
yeah, I was just trying to make it a little more clear because if we start to talk about adding disclosure when you've got these oral agreements or these reservation of rights, you're starting to add a whole lot of complexity. And so I was trying to kind of keep it a little bit more simple in terms of what the disclosures were, so that it would still be a red flag for somebody like David to know what has happened in it.
Robert?
I'm struggling with my technologies this morning. The thing is, these we call them nervous clauses, is what we call them around our organization. Something happens that was totally unanticipated, totally unexpected, really affects the company, but was not really talked about in a covenant. And the conversation would be, "This has happened to you, and we're really worried about it, and we need to talk about it." And then the conversation would go on from there. So to me, the conversation around these starts about very unstructured things that aren't anticipated. To try to draft standards about when it needs to be disclosed, I think would be terribly confusing, because the question would be, okay, they told us they're worried about us. Does that mean that triggers a disclosure? I think this needs to be simple. If the bank says we want our money back, then it's reclassified, and that's when it happens. Because I don't know how all these unanticipated, unexpected things that could occur, I don't know how you define the day when you have to disclose that bad things have happened.
Thanks, Robert. Adam?
Couldn't agree with Robert more. I'll clarify my earlier comment. I mean, I do think we've learned a lot in this process, and in different letters and different warnings, and reservation of rights just says, as I understand it, we have rights. I think in my mind, keeping it simple, requiring disclosure when there's been a demand for repayment, knowing that, when you go along this path, there's a lot of other triggers and disclosures that are in financial statements. We've got going concern evaluations and liquidity concerns, and most normally there are very objective covenants that are also included. And usually, as I understand it, and anything I've seen, this all happens together. And as I understand, the lender isn't going to want to call the debt just because, right? It's because of all these other underlying conditions, and I think all those other pieces are designed well enough to give appropriate disclosure, and that the user would still have the level of information. This particular clause, and trying to understand what it by itself will or won't do, no one really knows.
Thanks, Adam. Rich?
Yeah, just maybe for the bankers, I'm curious, is the preservation of rights, does that trigger a cross default, or is it only the calling of the debt?
Yeah, I was going to kind of add that, right? Like, particularly for staff, you can call a default, right? And then you've got your cure periods. And then there's an acceleration. So we use those words kind of the same way, but they're not truly the same, right? Like, you call a default and then you decide if you want to accelerate the debt, right? Or do you just want to work something out to then keep the debt out there, right? So, yeah, I would think calling an actual default, we send out reservation of rights every day. And so those aren't calling the debt, those aren't accelerating the debt. And they don't cause a cross default. And we basically tell them we're going to reserve our rights to call this a default. Let's talk is kind of the way I view that. But cross defaults would have a threshold a lot of times, right? So any debt over $10 million that's in default would then default the bonds or whatever that might be. But it has to be a called default, not necessarily, depending on how it's written, but that's how they're cross defaults are typically written. Some are cross acceleration, right? So I
Right.
have to sit around and wait for someone to actually accelerate their loan. That's all negotiated, but I would say the default is really, a true default that then starts the clock on the cure periods.
Okay, thanks.
Clear as mud. Doug?
I was just going to pivot since I wanted to wait, but I wanted to specifically comment on the disclosure piece now, not necessarily focus these comments on the subjective acceleration clauses, and just highlighting what I feel like I saw in the outreach of a lot of lenders saying enhanced disclosures are important. I know we as a PCC obviously very conscientious of adding disclosures and obviously wanting to ensure users get the relevant information they need. And so it seemed that most of the outreach was around additional disclosures specifically on covenants, and that the detail provided in disclosures today is not sufficient enough to understand either what covenants had been breached and the nature of those breaches. So maybe just I hear that outreach, and I think oftentimes it's like we know from the PCDMF that access to management red flag approach is something that we can sort of tether to, and so maybe just wanting to understand a little bit in more detail on, and it was helpful, staff, thank you for in the memo highlighting what all the existing disclosure guidance on debt is today, because I think when I was reading that I was like, isn't there a requirement specifically around covenants? And there isn't, which was sort of surprising to me. I feel like private company financial statements I've seen, there've been some, but I feel like the disclosures is very much like we have quantitative and substantive or qualitative covenants, and currently we are not in default of any of those, and that's about the extent of the disclosure. And so
Doug,
maybe just
Ashley actually had some more tee up to give us about the
oh,
disclosure.
sorry, are we did I jump ahead?
A little bit. It's okay. So
Well,
keep going.
All right. Well, thanks for leading us into disclosures, Doug. So during the June meeting, members indicated that debt disclosure should be considered as part of this research project. As part of our previous outreach, private company users have expressed a need for enhanced debt disclosures. At the September meeting, we had a very robust discussion on SACs, and so we did not have time to discuss disclosures at that meeting. So we have identified two potential approaches to debt disclosures, including a narrow scope approach, adding disclosures only about triggers of SACs, or a broad approach, which could range from requiring disclosures just about events of defaults to requiring certain disclosures that are currently only applicable to public companies. So there are three questions in the materials that we can discuss. So the first one asks for user input on whether enhanced private company debt disclosures are needed. Question 4 asks if PCC members want to pursue a narrow or broad approach to disclosures. And question 5 asks if PCC members think additional outreach is needed in this area.
Thank you. Sorry, I couldn't get your attention. David?
Yeah. Now this is somewhere that I want the accounting profession to actually get involved, right? And calculating the covenants, right? And if you, and I know it's not the way it always works, that you're in there calculating their covenants and checking the math and making sure that lines up with the agreement, right? That would be great, but that's not really what happens. But yeah, I think this is where, there could be real value add to a user, just understanding that, you've looked at the covenants or they've calculated the covenants and they seem to pass, right? So that's where, we could really use, I think, additional help and disclosure of, the covenants are there, they're calculating them. And as far as you can tell, not that you can interpret, because sometimes we don't even interpret what we wrote many years ago the right way. So, but long story short, yes, and I think people we've spoke to certainly, pro side RMA, others, would certainly welcome some more work around that topic. And if because ultimately, if you think someone has broken a financial covenant, even if it isn't a default, right, it could be a default, with the passage of time versus someone deciding they know that the subjective clause has been kind of tripped. So that's how I would differentiate the two.
Thanks, David. Michael?
With respect to disclosures, I guess I'm supporting a narrow scope with the subjective acceleration clauses. That does not mean that I don't think we should. I think we should have a project to see what lenders or users would like in terms of disclosures, and that's each specific one and asking for feedback. I feel like there's definitely demand for extended disclosures, but I don't know if we have enough outreach and research at that point yet. So I don't want those disclosures to hold any improvement with subjective acceleration clauses being held captive.
Doug, touchdown.
Yeah, just to maybe double down a little bit, David, on your comments. So I can speak, from the preparer and probably even the practitioner perspective. Quarterly, annually, we're looking at our debt agreements. We're pulling all the quantitative covenants, right? Debt to EBITDA, fixed interest charge coverage ratios, all those things, right? We're doing calculations and we're red or green. Are we in compliance? Are we out of compliance? And that's, those procedures are happening in detail. I guess from a user perspective, is the desire for more enhanced disclosures around which quantitative calculations are tripping? Because I think, just speaking plainly, it's if you're in compliance, I think we'll state in the disclosure, we've calculated all of our quantitative ratios and currently are all in compliance. And maybe that's satisfactory for users. It's more if you are in default of any of those specific ratios, getting into more detail on that. I guess just trying to understand a little bit more about what information would be more helpful from the user's point of view that maybe they're not already getting in those scenarios.
Just maybe just factually, can we just back up for a minute? Auditors, don't you test compliance with financial covenants, and doesn't it affect the classification of debt? And then don't you look at every cross default and move those debt to current if you haven't gotten a sufficient waiver? So that's happening today. Just to be clear, they may not issue a letter to the lender that says here's the compliance with the covenants, but they have to do that as part of their audit in assessing whether the debt is current or long-term, right? Just Adam getting a lot of nods from auditors. So I'm just making sure that didn't disappear in the last.
I was going to say the
years.
same thing. I mean, in a private company, usually the lender is the primary user of the financial statements, and there's a heavy focus on debt covenant compliance, and that is looked at. You look at if there's quarterly requirements, you look at it, the requirements through the year, you test at year end. And the auditor in me will say that many lenders want more specific evidence, and we're happy to provide other attestation reports on the covenants themselves that are separate and apart from the financial statements. That is a service we provide. So anytime you want to ask, David, we'll do that for you.
But I also
we won't just give random letters, but we'll happily do an AUP or some sort of agreement to look at those covenants for you.
Rich, I think what happens in practice, so the difference between auditing in the public space, where the SEC requires significant disclosure about waivers that have been received. In the private space, GAAP is really silent on if you've gotten waivers.
I am fully on board that the private company debt and covenant disclosures are significantly less than the public company debt and covenant disclosures. But that point on you have to assess compliance with covenants for classification purposes, that's GAAP. That's not public GAAP. That's all
Absolutely.
GAAP.
Disclosures are different, but the work should not be.
Yes. Okay.
And sorry, just functionally speaking, I mean, that's what happens anytime there is an issue is generally the statements don't get issued, right? Generally, when a private company statements linger out forever, it's because a covenant has been tripped. The client doesn't want to deal with the classification. The client and the lender go into negotiations, and the auditor just goes on hold until something gets, I mean, practically speaking, because as soon as the covenants get tripped, you run into going concern issues, and suddenly at that point, lender and management understand the situation, and they take over. And then at some point, when the resolution is found, then they come back and decide when they want the audit report.
And maybe just to follow up on that, if it's more of a technical violation, maybe, I don't know, something like where maybe the company isn't necessarily in financial distress. And my experience is that I've seen emphasis of matter paragraphs in the actual audit opinion to highlight either the debt covenant violation or something has been tripped or something has been changed, which then sort of directs you to a footnote. And this is in a private company space. Is that something that you see often, this sort of emphasis of matter paragraphs?
Yeah, I mean, assuming the debt's significant, that would be something that would likely be an emphasis matter in the audit report. And even then, it's if it's just a technical item and it's not that big of a deal, then it's usually not that big of a deal for the bank to give a waiver of some sort. So to the extent that it was material, it would be material to the users that could rise to an emphasis matter. That there's a element of judgment there, but certainly when you start getting to like liquidity notes or any like say significant issues, you'll see an accompanying emphasis matter.
Holly?
And kind of go back to a little bit of where Mike started, that I also kind of agree with, like, the narrow approach for subjective acceleration. Kind of one question for the practitioners, because in your private company financial statements, the two disclosures, because I know users want everything. The two disclosures that I always thought were meaningful was one, whether you were in compliance with your debt covenants, and the other was, the assets that are subject, that are under lien. I mean, and I always did that in my past practice, but as far as our private company practitioners, are those two disclosures things that you normally have?
I think they're assets under lien. At least my experience, it's usually like substantially all assets are on them. So it's like one line. I don't know that it's all that meaningful. But the other disclosures are there for sure.
Yeah. And I think I would also echo that, Adam's comment about, at least in my private, we would always work with the bank if for some reason we were did not meet a covenant, and the financials didn't get issued until you went back and renegotiated a waiver, or, worked with your bank so that you had a waiver so that you could issue your financial statements. So that is pretty typical, that process just gets delayed until the situation gets resolved with the bank.
Christine?
So I actually think it's that delay in the financial statements being issued, and then the fact that there was at the balance sheet date a problem with a covenant that is no longer disclosed is the issue that the investors have. They want to know what was the situation at the balance sheet date. And if there was a covenant that was violated, even if it was waived at a later date, that's what they wanted, because there's something going on. And they want, to your point about red flag, that they want to see that there's a red flag and maybe there's something more I need to ask managers about. So when I look at the feedback that we got from ProSite, they were asking for information on violated covenants. Obviously, if it's violated at the time that the financial statements are coming out, that should already be disclosed, is my understanding. But covenants that were violated and then waived subsequent to the balance sheet, they want it highlighted if there's covenants that have been amended, because that might also be an indication of something that they need to ask about. Covenants that were added was another one. So I think those are pretty reasonable things to ask for. And I don't know that we need a ton of additional research to say that should be something that should be pretty cost effective for companies to provide. So, I think one argument against disentangling these is that I think if they do get disentangled, it's quite likely that the SACS issue will be dealt with and the disclosures will never be dealt with, or at least not in a timely fashion.
Well, which is what happened when you guys had this on your agenda before.
Absolutely.
There was another good issue
Yeah.
that you were trying to do, and the bad issue
And the
got left
bad
behind.
issue, yeah,
Adam?
exactly.
Yeah, I mean, well, first of all, I'm in favor of the narrow scope disclosures. When a covenant failure has happened and a waiver has been obtained, that that makes it to the disclosures in the financial statements. That's not just wiped away, that those events will appear in the debt footnote.
I think if it's been waived, there's an argument under GAAP that they don't have to.
Yeah,
And,
I don't
and
think there's
I
a
know I've had enough
requirement
arguments
to.
with borrowers that are like, well, show me in GAAP, and well, what
Have
about
to
an
disclose
SX?
this.
And like, we don't follow SX.
Why
so.
else did we hold our financial statements open for 6 months?
Correct.
If you're going to
No,
make me disclose it anyway.
I think there might be a difference in practice, but I think I'll say the more sophisticated financial officers ask you to point to somewhere in GAAP that they're subject to that disclosure. Again, I'd say auditors win most of the time, but not all the time.
Fair. Most of the time that ends up showing up. And often with a waiver, there's some sort of renegotiating the agreement, right? The agreement changes, and that, I guess what I'm trying to think, I haven't seen many cases where there wasn't some amendment to the agreement that doesn't get triggered into the debt disclosure.
Well, I think the place that we auditors also run into problem, and I'm both a past accountant and a past auditor at this point. I think it's covenants that will be violated in the coming year that are also kind of problematic, because arguably those aren't required to be disclosed either. So I think this would be in the red flag area that I think users would be very interested in. What's the expectation in the next 12 months about what's going to happen with the debt. David?
Whoops, I just wanted to, because it was on point. I would say, here's an opportunity to take cost and complexity out of the system, because apparently, there has to be this big debate about whether to disclose or not. And if it was just clear that it should be disclosed, it'd be much more straightforward.
I guess to the question of narrow approach and comments of users always want more, I mean, is there another use for financial statements that you use them for than like the users? Right. And so I just wonder, like, why would we take a narrow approach, right? Like, the people who are using them are asking for more disclosures. And if it doesn't, there's a cost benefit analysis, right? But why would it need to be a narrow approach? I don't understand the rationale.
Because I think sometimes we focus much more on the noise we hear from preparers, which is not fair, but we hear more from them than we do from users. So I think that's an excellent observation.
Jerry, not sure if there's another tee up or not, but I just wanted to go back to yeah. If it's on disclosure, I would like to let them tee up disclosure, because I wanted to go back to the comment that said that. So one thing that would probably be helpful to the board members is, if the PCC is going to do something and look at disclosure, are you only looking at disclosure related to covenants, or are you looking at private company debt disclosures more broadly? Because I want to come back to the point about assets subject to lien. That's a public company disclosure. I'm not aware that that's a private company disclosure. If it is, if somebody can give me the private company reference, but I don't believe it is. And I think there's a great chart on page 12 from the staff of all the public company debt disclosures that are beyond those for private companies. And, we all read the paper, and, apparently people can double collateralize assets, little things like that.
Well, they actually can't, but they do.
Apparently you can. Maybe you shouldn't have, but apparently you can. So I think that would be helpful, because to the extent the PCC is not looking at that, there may be some interest at the board level to look at that private company debt disclosures more broadly.
I agree. I actually think if we're going to do something, we should go big on this. That the narrow approach, I don't think, achieves really the objectives. And I want to give them the subjective acceleration clause thing in exchange for making them do more debt disclosures. So, let's give them a little candy. They may not think it's so sweet, but nonetheless, let's give it to them anyway. Because they should have all this information. I don't think this is complicated. I can see why people wouldn't want to do it. And I think we do have the near past evidence of, multiple liens being established on the same assets, that the company should be substantiating. It shouldn't be more work, quote unquote, for the auditor for them to do that.
All right, quickly moving on to applicability to private companies and next steps. As you know, the PCC only has the authority to make decisions for private companies. However, if the PCC believes that the identified problem is broader than private companies and that the potential solutions would result in better accounting for all entities, the PCC could consider making a recommendation to the board at a future PCC meeting to add a project to the FASB's technical agenda. In terms of our next steps, the staff will continue conducting research and outreach based on your input from today, and will more fully analyze the FASB agenda decision criteria and the PCDMF. We'll also have a screening with the PCC Technical Agenda Consultation Group before the PCC is asked to make an agenda decision. So with that, there are two final questions. Question 6 asks for PCC members' views on whether the areas being explored should only be applicable to private companies. And question 7 asks what additional information is needed to make an agenda decision in the future.
Well, I won't speak to the issues impacts on public companies for these, but these things we're considering on debt, I think would be applicable to other entities like not-for-profits for sure, because clearly often they're much less sophisticated and still have all the same challenges that private companies do with respect to debt and debt disclosures.
I just say in my space, I obviously cover both public and private companies. And so I think the desire would be to, if we can come up with something, particularly around this waiver issue, which I think is a big one, that would apply across the board, I believe.
Thank you. Jackson?
I was going to make a suggestion that when we take this information back and write it up, that the staff include a comparison of private and public, because we know there are more disclosures required for public. And if we identify disclosures for private that are not made available to public, we could make the PCC could consider that decision at that point in time.
Great, thanks for that. Do you guys think you know what we want you to do? I think they do. So thanks for that dialogue. And I think we'll be pulling together some materials that we'll see in March, so about adding an agenda item related to this, and then figuring out what that means relative to passage or a recommendation to the board overall. Awesome. Congratulations. Almost. Wait for our next FASB staff group to come in. Welcome, Ashley and Edward and Alicia, and you're going to talk about equity method.
That's right. Thanks. Good morning, everyone. The purpose of today's session is for PCC members to provide feedback on the equity method targeted improvements project that the board added to its agenda last month. The board issued the 2025 Invitation to Comment, or ITC, to solicit broad stakeholder feedback about the future standard setting agenda of the FASB. And as a result of feedback received in the equity method, including feedback from PCC members, the board added a project to its technical agenda last month to improve the operability of the accounting for equity method investments. Additionally, at that meeting, the board decided the project would focus on 2 narrow scope issues versus exploring a holistic change to the guidance. The first area focuses on addressing the accounting for equity method investments in partnerships and similar entities that are required to use the equity method based on meeting certain quantitative thresholds of influence rather than because the investor has the ability to exercise significant influence over the investee. This area was included based on feedback that stakeholders struggle with the unintuitive outcomes that result from having different thresholds for evaluating influence in different types of entities. That is because the presumption of influence for limited partnerships and similar entities is 3 to 5%, as compared to 20% for investments in corporations. Investors say that they often have to account for investments in limited partnerships under the equity method, even though they are unable to influence the financial and operating activities of that investee. Additional details on the thresholds of significant influence and the feedback received on those thresholds is included in paragraphs 10 through 14 and 40 of the memo. The second area the board decided to pursue would be to clarify how equity method investors in non-real estate entities should determine their share of an investee's earnings when the investee has a complex allocation structure. As noted in paragraph 16 of the memo, in a complex allocation structure, an investor's share of earnings may not be aligned with its ownership percentage, and determining the investor's equity and earnings requires careful consideration of the substance of the arrangement. In these circumstances, investors often calculate their share of earnings by using the hypothetical liquidation at book value method, or HLBV, which, as described in the memo, is based on non-authoritative guidance. ITC respondents indicated that applying this guidance is challenging, especially because there is no specific guidance in GAAP. In pursuing these two areas, the staff is exploring various paths forward, which are described in paragraph 44 of the memo. The first area, path 1A, explores whether the scope of topic 323 should be clarified, or under path 1B, whether those investments that are subject to the 3 to 5% threshold I just described should be permitted to apply a measurement alternative similar to the one in topic 321. The second area would concurrently explore three paths, which are listed as paths 2A through 2C in the memo. This includes exploring what industry-specific guidance in topic 970-323 more broadly applies to all equity method investments, and whether that guidance should be in the overall subtopic, whether there are any key challenges that could be clarified in the accounting for complex allocation structures, and lastly, what illustrative examples could be added to GAAP to show application of a methodology like HLBV as an acceptable approach for allocating earnings in these structures. And so with that, I'm going to hand it back to Jerry to open up discussion on questions 1 through 3 in the memo.
Thanks, Ashley. So, in the past, we've had a education session about this topic for the PCC that the team provided. And so, to the extent that you have questions or comments about these things that we think are relevant to private companies that we want to bring to the board's attention, let's get them on the table now. David Hoagland.
Thanks. This is something we have a lot of experience in my space, right? And so I guess the more I learned about how it sits today, it just kind of feels like it's right. I guess people talk about, well, in a 3 to 5%, I get bad outcomes, right? But I think that's, kind of a side point to if you make it, 15 or 20%, right? Like you only have one investor, and even if it's not legally in the document, we see so many times that the investor's more important than others, right? And so what they want to do kind of counts, right? And so that's their future partner in other projects, whatever it might be. So I'm reluctant to make, if there was 100 investors and they were all at 5%, that would make more sense to me, because you really don't have influence. And I understand why you get the outcomes that you do, but I don't think there's really a test that says you're one of 100 investors and that all have 3 to 5%, right? Or whatever the math would be, right? But it doesn't, if you're the one investor and you make it 15%, right? That 15% investor is pretty important to you, because it may be your lifeline to future equity investments and other things. And so there's a lot of influence there, right? And we see it every day that in our partnerships, and granted, we do real estate, but the asset could be anything. It doesn't really matter if it's real estate, non-real estate. large investors, right? And large is a relative term. It depends on how big your investment is, tend to, produce and, influence, decisions every day, right? Are we going to support this project? Are we going to put more money into the project? And so, I don't know, just felt like the more I understood about the different thresholds, I don't know that trying to solve for someone's bad outcome on a couple of investments really make me feel like there's a higher threshold, unless there was some accompanying, like you're one of many investors that, probably, but then you still get the, who's the most influential investor that you're dealing with out of those 20 investors that all own 5% or 4% or whatever it might be. So just some opening thoughts.
Thank you. Douglas?
Yeah, thank you, staff. Great memo. I think also the education session yesterday was extremely informative. I'm extremely happy that this is a topic that's on the agenda. I think it's ripe with complexity. I hear a lot of David's points. I think the equity method model has a lot of merit to it. I think it's actually a very strong model. I think the biggest opportunity is really in what gets into the equity method model versus what doesn't, and particularly around the partnership structure entities. I don't know. I don't know if the standard was initially written with the intent of bright lines for 20% for Inc., for corporation entities in this 3 to 5 bright line, but in practice, I think those bright lines are used. And I do think oftentimes can result in not great outcomes. And it's probably more so on the partnership entity side. And so if the answer is relooking at, do we have those bright line percentages in there? Do we really double down on how are we defining influence and what really constitutes a significant level of influence? I think could handle a lot of the complexity we see, particularly again in partnership structures where, at least in my experience, you end up in an equity method treatment for investments where your ability to truly exert influence is very, very limited. And I do have a lot of experience in seeing that. So I think if I were to make a recommendation on how where we would put the most emphasis, it would be in that piece of the model. I think when you start getting into, once you're in equity method treatment, particularly around the topic of complex allocation structures where the amount you would receive in the event of a liquidation is different than your percentage ownership, which again, I have a lot of experience seeing. Yeah, it doesn't make sense to do equity method accounting based on your percentage ownership because that doesn't ultimately reflect the assets. And that's what users want to see. They want to see, what are you actually going to receive in the event that this investment, liquidates, and what assets would you have access to? I will say things like the HLBV model, which was younger in my career when I was attempting to apply that, it is extremely difficult. And I do think a lot of it is ripe with error today. And I think we find ourselves in this sort of tension of, there's a lot of errors. I think a lot of private companies specifically do that wrong. They either misappropriately just apply ownership percentage when doing their calculation, or they try to employ something like the HLBV model and don't do it very well, or they require a ton of help from their auditors. So it's this tension of, it's hard, but also the intended outcome of that hard is really beneficial, particularly for users. And so maybe there's a balance of, can we make that easier, but still preserve the nature of what the guidance is trying to get you to, which is a reflection of equity earnings that truly aligns with what you would ultimately receive from that investment. And so I think that's hard. I think that will be a difficult path to find a simplification that still preserves what I consider actually to be good guidance and a good outcome. And so maybe that would be a secondary path of pursuing some of those simplifications. But again, I'll just reiterate, I think the biggest opportunity here is in that definition of influence and making sure we're only getting things into the equity model that really should be in there.
Thanks, Doug. Holly?
I was going to probably echo somewhat of the same thing about, especially on the partnerships, that the 3 to 5% doesn't seem appropriate, especially when you've got a general partner who really is the entity controlling the overall limited partnership. So that's it.
David?
Yeah, just say on the second piece that Doug hit there, I feel like if you can put together a really difficult structure with, and having all these smart auditors, right? It seems like why would we need to simplify it, right? You built the mousetrap of how the partnership works, but you don't know how to account for it. How would you ever know how much money you're owed if you can't do the math, right? So I don't really understand. If you guys can't support the math, like then why'd we do the partnership? So I guess I'm challenged to really, like, I don't know, somebody put this together. I don't know who it was. The board did a good job at the time because it just seems very logical, right? That, if you're smart enough to build all those mousetraps and the partnership, you and your auditors can figure out how to allocate the percentage other than just ownership.
Complicated transactions might require complicated accounting. Doug?
Yeah, and I definitely don't disagree with that sentiment. I think in practice, oftentimes the people that are designing these very complex models aren't often in close connection with the accounting department that then has to consume that. So I agree. There's probably an opportunity there for, hey, if you've got really smart people in the room that are designing these complex allocation structures, then having that better connection with the accounting departments. But that's just not ultimately the reality. I think the other thing that's interesting too is it's called the hypothetical liquidation at book value, because it's not, hey, if you have a bunch of assets and you sell them, well, what you actually receive for those assets is market value, right? And there's cost to sell and there's all these things. Well, in the HLBV model, it's just you're taking the book value and you're doing it based on that. So it's actually the outcomes that you're getting from that are not even really necessarily fully reflective of if it was actually liquidated. And so I think there's nuances to that model that are just complex from an accounting perspective, that even if you understood how assets were ultimately allocated in the event of a liquidation, how you account for it under that model is just complex. And so I think maybe that's where there's opportunity, is the application of the actual accounting model around how you determine that. There could be some room there. So again, you're still getting hopefully to a spot where a user could look at that and say, I feel good about what's reflected on the financials as being a reflection of what the investor is entitled to, but somewhat simplify the approach of getting there from an accounting perspective.
No, I think if you had the nuts and bolts of the calculation, then you can make some assumptions around market values and the other things, right? It's just putting that together so that you ultimately understand it. And so if you do have a question about it, then you can, see where the waterfall. It's all about the waterfall, right? At the end of the day, and who gets what when, and you can, we make assumptions every day, but having that, making sure everyone looks at it and says it's right, the accounting, the outcome is probably less important than that we've gone through the process of putting the elements together to at least approximate what it should look like.
Mike Chang?
Hearing this discussion is interesting. I do think it's complicated when you try to allocate equity earnings. I guess my specific comments is related to paragraph 44. I think I would be supportive if, based on the scope, right, there's a difference between a partnership model and a corporate model. And I think that's why there's a different line of 3 to 5% versus 20%. And it's interesting that if you are roped into the partnership model, but you don't have the influence to get all the information you need to calculate the allocation, it presents a very significant problem for you. So I think for those reasons, I don't think we should get rid of the equity method model, but path 1B seems to make sense to me, because today you could elect the fair value option for any equity method investment. But I think the difference here is allowing you to use the 321 measurement alternative that says it's cost plus changes subject to impairment, which I think would be helpful. I think there would be some loss of information, but if you do apply the equity method, things just aren't as straightforward as they seem. We're going to have to make a lot of assumptions. I don't know if people are going to be applying it consistently. And I don't think people even know to look at those different probabilities if you ask an average auditor out there. So.
Thanks, Mike. Holly? Oh, Rich, you want to touch down?
Yeah, maybe what would be helpful too is just, Michael, your comments kind of prompted this. The basis for equity accounting for an LP and LLC is that you have an individual ownership account, not that you have significant influence over the entity. Versus for corporations, it's an evaluation of, do you have significant influence over the entity? And we, rightly or wrongly, that was done solely for real estate partnerships, but now has been applied to everything else. So I'd come back to, do people think that because you have a LLP or LLC, the unit of account should drive equity method accounting, or do you think it should still be an evaluation of significant influence over the entity? Because that's why we have 3 to 5% versus 20%. That's the sole reason, and that might be and if you think partnerships are different, then you probably don't want to change practice. If you think, no, it should be one evaluation of the entity as a whole, then you probably do want to change the way we account for when we apply equity accounting for partnerships and LLCs.
Thanks. Holly? No, sorry. Hillary.
Too many H's in a row over here. No, I was going to make the point that Rich makes, just that is a distinction between how the models are set today. And obviously, one was set by the SEC in 1995, and one was the FASB thinking about this, as kind of a holdover from previous guidance. But the one other thing, just with regards to the HLBV approach, I think you're exactly right, David. Follow the waterfall. Like, that's what I think it always came down to in practice. Is there may not be extensive guidance in the literature today. I think clarifying that you do have a different model to apply if you have a complex allocation structure is really important. I do get a little concerned of how prescriptive to make that guidance, because you have a complex allocation structure. I don't know that I ever saw two of the exact same structures in practice, but I think a concept of follow the waterfall and understand some of those basic premises could be really helpful. But curious, I think that's one of the things we'll be asked about. Is I'm sure folks would love very prescriptive guidance with regards to how to apply that model. I don't know that that's really a great feasible solution or all that helpful if we are going to have very different types of allocation structures out there. So just something to mention.
And I'm going to interject, I said this before. Our role here is to tell them in substance whether or not we think private companies should be different. So, as we're going through the rest of the dialogue, do we think that they should follow the same model, or should there be less disclosures? Are there other things that we want the FASB to think about as they go through this?
So I just wanted to pursue Mike's preference for 1B. So 1B says permit a narrow subset of equity method investees to have this option to effectively use cost method. So my question for you would be, did you have thoughts on how to scope who would have access to this option, or would it just be a free choice if you've got, if you'd otherwise be in equity method accounting, you have the option to go to what would effectively be the cost method?
I think we have to define whether you have that significant influence or not, or come up with factors. So I think it can't just be you're at 3 to 5%, you can apply this, and that's how you got roped in. I do think we have to define that narrow scope. Just to be clear, I am supportive of a hypothetical liquidation basis. The problem I think we run into is if you've only got 3% in a partnership, someone can tell you, here's your capital account and this is what your balance is. But if it's an amount that is material individually to the company and it's going to end up being equity earnings or an adjustment to your P&L, you have to audit that. I think the problem is getting into all those agreements and having all that support done in a timely basis. And I think there is a uniqueness to private companies in that there are more, I don't know if there's more, but seems like, and I have no basis for this, but I feel like there are more investments in partnerships and flow through entities in the private company space. So I think that's it presents unique challenges where you might not have the ability to say, give me the numbers, let me audit it, and let me get a P&L number that's going to be accurate. So I think it's just a pragmatic approach. Now, if you hit significant influence, I think you should be subject to it, whatever those factors are, because it's a better indication of your claim against that entity and what you're going to actually materialize.
Okay, that's helpful. So you're saying if there really is significant influence, you should think they should be required to follow equity method.
Yeah, because I think the way you explained it is you've
Yeah.
got a capital account, that's what you're owed. And if you can audit it, that's great. And I think if you do have significant influence, you can exert that influence to get the information you need. It's just, what if you only have 2%, 3%, 4%, but you don't have audit rights or access? Or maybe even if you do you have it on a timely basis to get that information correct?
Thank you.
So Holly?
I don't want to go back and address Rich's comment. And, I think even though, partnerships have that unit of account and yeah, you could easily pick it up. But I think that's what I struggle with is the overall principle. Equity method is about significant influence. And it seems contrary to that. So that would be my one comment. And then the other comment I thought about, dear, about the HLDV, I'm probably saying it wrong, but is there an alternative for private companies that says, okay, we're just going to do our 20% instead of trying to do this complex allocation and all these calculations? Okay, here's the other factors that really go into this versus disclose the issues or the waterfall versus trying to calculate it, because that seems to be where there's some really cost and complexity for both the private company and their auditors. So maybe just do the typical 20% with a disclosure that, hey, we know there's other things out there that might ultimately impact what you're going to get in the long run. Just a thought.
Mike, do you have anything else to add? Or did you cover your topic when answering the question?
No, I covered by clarifying.
Doug?
Yeah, Christine's question was a good, because and Mike is kind of responses both back to that conversation of, I was initially on a 1B approach, which was, hey, let's find this scope and say, hey, even if you're significant influence, you get into this scoping where you can have a cost basis approach. And then I thought more on it, and that's where in my initial comments I said, well, let's actually focus more on, do you have significant influence or not? And if you don't, and I think there's just more going into that today. And I think that's what you guys were kind of getting to is, if you have significant influence, you need to apply the equity method model. Maybe we can relook at how we're evaluating what significant influence is. But then I think maybe, Holly, back to what you were saying of, well, hey, is there an expedient or whatever for a private company that if you have a complex allocation structure, you just default to your percentage ownership to reflect earnings? And I don't agree with that. I think if it's material, you should be following the waterfall. I just wonder, though, if there is a way to scope for immateriality, or if it's, I don't know. I still do think there is merit to an approach of reflecting a cost method or a cost-based. And then if there are, and just under the measurement approach, if there's an indication of fair value, you would need to record that at fair value. It's not a cost method. It is a fair value method. It's just if there are no indications of that fair value. I think there's merit to that path. But again, I kind of reiterate the point of, I think let's focus first on, do we have influence really well defined, and making sure what's in and out of the model makes the most sense. And then I think from there, potentially where there could be a practical expedient for a private company, to Jerry's point on what could we pursue for private companies, are if it is in some sort of materiality or whatever, or if it's lower value, could you default to a path 1B approach of a measurement alternative, even if you determine its significant influence? I think Christine's question around how would you scope that would be highly critical. But then that gets you out of all doing waterfalls and everything else. So I do think there could be merit to that approach, for sure. The scoping would be hard, but I think there's merit.
Thanks. Mike?
I guess just stepping back, I think the issue that comes up in practice is that if you breach 20%, you're in the corporate model, you breach 20%, you're already in equity method. I think those factors of significant influence become more important when you're below 20%, but you're on the board, right? Or you've got rights or influence that exceed, and you're below that threshold. The problem, I think, with partnerships and flow-throughs is that same line that we're talking about falls to 3 to 5%. So you could still have significant influence at 2% or 1% if you have all those factors, but it's like you hit 3 to 5, it's very hard to get out of that. So I think what we're saying is this: if you're in 3 to 5, that's fine. Maybe you're still in this 323 approach that has this measurement alternative, but it's not a presumption that you have significant influence. It's kind of here are the factors to see whether you do have significant influence. I think it's kind of flipping the order and saying that you're not guilty until proven innocent. It's okay, if you breach it, that's fine. You still have to assess that. And if you do have significant influence, then talk about the complex allocation models. If you don't, go ahead and apply an easier approach because it's probably not as important of an investment if you don't have those rights.
Thanks, Mike. Rich?
Yeah, I just want to kind of go back to this conversation, make sure I follow. So if the board were to pursue significant influence as defined by at the entity level, that would obviously raise the threshold above the 3% unless that 3% interest holder has an awful lot of power over that GP, right? From a practical matter. That would mean that more and more of those investments would fall into the, I'm assuming, fair value method with the measurement alternative that we're talking about here. So by default, it gets you some of these into your 1B model when significant influence doesn't exist. Is that enough? Or are you really looking for, hey, there's this 25% LLP owner who can participate on the committee to kick out the general partner. They don't control it, but they can participate on the committee. That's probably significant influence. You want them to be able to go to the cost method / fair value / adjustment for observable transactions. I just wanted to follow.
Yeah, no, I think if you're looking at like 2015-02, the kick out rights, if you're on a committee that can kick out the GP, I think you sit in a very different position. I think that just having cost basis is a difficult pill for me to swallow.
Right. So said another way, once you have an LLC or LLP interest that gives you significant influence over the entity, you're not looking for this 1B. It's only if we didn't change that and we still had these 3 to 5% ownership accounts that were on the equity method that you might be more interested in 1B.
Yeah.
Okay.
David F.
I'm just wondering if part of our consideration around these pass-through entities on a cost basis is the fact that there's so much fluctuation that actually does pass through to the holder, even if you're a minority holder. So with a corporation, you're holding the stock, you're not necessarily in any type of liquidation, place. You're not receiving any value until there's a transaction. So like the cost basis makes a little bit more sense because none of that's really going to pass through you. When you're sitting with as a partnership, there's active pass through of income, expenses, etc. That would even if you don't receive that as actual cash, there's more fluctuation in those values that do impact your carrying amount versus treating it at a cost basis. So even if you are a small holder, it seems to make more economic sense to kind of have that equity method approach than a carried cost basis.
Thanks, David. Any other comments for the staff on this section of their discussion? Oh, Mike.
I don't know if I can ask this question, but is there an overall consideration of just more issues related to equity method that the board is considering? I know that's beyond this because this is partnerships, 3 to 5% significant. But is there, or is that kind of too early to ask?
I don't know that we've fully defined exactly what we are or aren't looking at on the project yet. So if you have other issues around equity method, I'm sure the board might be interested to hear them.
I don't know if it's been raised, but I've run into, it's not like this is a very frequent issue. But when it does come up, there's not that much guidance on it. So it's the fact that when you have equity method, you net transaction costs against the investment by referral to 80550 because which I don't know if people catch that, but that's under an asset acquisition model. I always found it a little odd that I think if you're in equity method, you're more akin to operating a business, right? And we even look to 805 in terms of purchase price allocation to figure out what your basis difference is and how you expense that. But in our most recent version of 805, we say that transaction costs are expensed, whereas when you have equity method, you net that against your basis. So it creates, I think, unnecessary cost or basis difference. The other thing too is you can get into an argument of what is your cost to actually enter into the equity method. Was it the research to see if you want to go into that venture? Is it the operating agreements, the lawyers you spent? So when that issue arises, I think it's just easier to expense that rather than netting it against your cost basis.
And you'd add that to the list of other items, like when you go from consolidation to deconsolidation, you fair value your equity method. And when you go up, I'm assuming it's part of the similar inconsistencies we have between the BizCom and equity accounting models. Okay.
Great.
Thanks, very helpful.
Excellent. Thank you, guys. And we'll get the next team in for digital assets. Welcome. Thanks for your session yesterday where you were educating us in digital assets. Jacob, are you leading the charge?
I am. Thank you. So our next topic, as you said, relates to digital assets, and I will provide some relevant background information in preparation for PCC members' discussion on the associated standard setting projects. So on the next slide, the FASB's 2025 agenda consultation invitation to comment included questions relating to digital assets and to cash equivalents. Stakeholder feedback highlighted issues for the FASB to address, including classification of stablecoins, crypto asset transfers, and derecognition, the scope of crypto assets included in the current guidance, the impacts of tokenized ownership of real-world assets, and gross versus net presentation, among other topics. Next slide. Crypto assets and stablecoins have also been the focus of several recent U.S. regulatory developments, including the Genius Act, the SEC's Crypto Task Force, and the President's Working Group on Digital Asset Markets that released a report recommending certain areas for the FASB to consider through public comment. The Genius Act establishes a regulatory framework for defining payment stablecoins and their issuers, including qualifying requirements like cash redemption and reserve assets, and notably also prohibiting payment stablecoins issued by non-permitted issuers from being treated as cash or as cash equivalents. Given the stakeholder input in this area, as well as the recent regulatory developments, today's discussion will focus on two priority standard setting areas: accounting for the transfers of crypto assets, which is related to the guidance in subtopic 350-60, and the classification of certain digital assets as cash equivalents. On the other issues raised by stakeholders in response to the 2025 ITC, the staff will evaluate and provide staff analysis of the FASB agenda criteria for those issues to the board in a future meeting. Next slide. The current gap in subtopic 350-60 applicable to crypto assets was released in December of 2023. This standard addresses subsequent measurement at fair value, presentation, and disclosures for in-scope crypto assets. However, not all digital assets are included in the scope. First, the scope only includes fungible, intangible digital assets that are not created or issued by the reporting entity or its related parties. Second, the board included a scope criterion that excludes assets that provide the holder with enforceable rights or claims to underlying goods, services, or other assets. Without that criterion, arrangements like contracts with customers, guarantees, or insurance contracts could inadvertently have been included within the scope. Based on this scope included on the slide, many wrapped tokens are not included because they may give the holder a right or claim to the underlying assets. Next slide. The current crypto guidance also requires certain disclosures, including quantitative information about each significant holding at period end, reconciliation or roll forward of additions, disposals, gains, and losses, and both quantitative and qualitative information about restrictions on crypto assets. Next slide. Moving now to the current digital asset projects on the FASB technical agenda. An area that many stakeholders highlighted for the board to address is the accounting for transfers of crypto assets. As I mentioned, some stakeholders who provided feedback on the most recent agenda consultation noted that certain crypto transfer transactions involve assets that are not within the scope of subtopic 350-60, resulting in operational complexity and inconsistencies. These stakeholders suggested that the board expand the scope to include economically similar assets like wrapped tokens or receipt tokens with the in-scope crypto assets that underlie them. In addition, there is no specific derecognition guidance in the current crypto standard. It refers to other GAAP for intangible assets. Stakeholders noted that entities rely on various authoritative and non-authoritative sources to account for crypto transfer transactions, such as guidance applicable to revenue transactions and derecognition of non-financial assets in topics 606 and 610-20, transfers and servicing of financial assets in topic 860, by analogy to accounting firm guides or the AICPA practice aid, and in reference to remarks from the SEC staff in recent accounting conferences and results from consultations with subject matter experts or regulators. Next slide. In its November 19, 2025 meeting, the board added a project to its technical agenda with the objectives of addressing these concerns. The staff is performing additional research and outreach on these areas at this time. So with that, we'll pause. We have a few questions for PCC member discussion. We've included 3 on the slide. The first question asks whether the scope of subtopic 350-60 should be expanded to include wrapped and receipt tokens, and if so, whether you agree with revising criteria B in paragraph 350-60-15-1 that currently excludes assets which provide the holder with enforceable rights to claims or claims on underlying goods, services, or other assets. Additionally, whether there are any other types of digital assets that you think should be added to the scope, and if so, what those are. The second question asks if you agree that the control guidance in topic 606 should continue to be applied to crypto transfer arrangements, and if so, whether you agree with clarifying the application of the existing repurchase guidance for these transactions when failing derecognition occurs because of certain repurchase or return provisions. Third, and this is primarily focused towards financial statement users, is there additional information such as disclosures about wrapped tokens, receipt tokens, or other digital assets that you would find useful in your analysis or of companies that hold those assets beyond the disclosures currently required in the subtopic 350-60? And I'll pause there for discussion.
Great. David or Robert, from the user's perspective, do you think private companies need to do anything differently that the FASB should consider vis-a-vis their other considerations of these assets?
Yeah, I would just say it's not very prevalent. And so, I don't see a lot of value in it.
Thank you.
I guess I respectfully look at it a little differently because I think this is an emerging technology, and I think there will be something will happen, much like a triggering event, and then this will all be on us in a rush. So I don't know that we need to reshape the world, but I think we need to make some steps so that we can begin to walk the path, because I believe this is a big part of our future, and I think we're going to see a lot of this. And I would hate to see us get behind on dealing with the issues that would emerge from this.
Thank you. Brad?
Yeah, I guess I just ask a question on the timing of this. While the Genius Act is passed into law, my understanding is there's several parts of this that can still change, including the reserve assets that are behind this. And so I'm a little bit tentative to say, to take a position without some of those details being finalized. And so is there thoughts to, the speed at which this progresses and how we move forward with the uncertainty that exists in the lawmaking process?
Go ahead, Jacob.
I appreciate that perspective. I think we do have some additional discussion that we will go into as well, relating specifically to stablecoins and classification of certain digital assets as cash equivalents following this pause to discuss. But to your question, I think on timing, the implementation, as you say, of the Genius Act is ongoing. And I think the timeframes for that, as described publicly, are for January of 2027, kind of as a date when that likely will be implemented by. So the aspects of how that is being implemented currently are parts of the aspects that the board is considering around what impacts it may have on projects relating to that classification currently. So that impacts the timing as well.
Great. Do we want them to go through the rest and see if there's other questions that come up? Oh, Mike.
Sir, I think you were focusing on questions on slide 13, right? For this point. This is not obviously in our practice, but if I'm understanding the three questions that you're asking for, let's say, stablecoin, if you expand the definition of that, it's going to change it from an intangible asset held at historical cost subject to impairment, and then it's going to mark it to fair value. And then once you do that, you're going to have a bunch of the disclosures like what the cryptocurrency is or the digital asset, the units, the cost basis, and the fair value. So I think what you're asking here is that if you expand that definition to include this, you're just going to get more information. But the biggest change too is the measurement guidance goes to fair value. If we believe that this is easily transacted at fair value and easily converted to cash, I don't see an issue with that if we define that well. And I think it provides a lot more clarity and information on that stable coin or whatever the digital asset is. So it kind of makes sense. I think it provides more disclosure. Right now, you don't get anything, right? Relatively speaking. So am I understanding that correctly, or?
Yes, that's right. I think whatever new assets would be brought into the scope of 350-60 would be therefore subject as well to the incremental disclosure requirements, as well as the presentation and measurement just requirements of that standard. So
yeah,
those would provide those incremental disclosures.
So today they don't get any of that, but if you do include these stable coins or receipt tokens, then you would end up looking, it's your slide 9, which is a lot more information than what people are getting today. So
for the wrap tokens, yes. For the stable coins, Jacob is going to tee up on the next topic.
Oh, sorry.
Yeah, specifically for stable coins. Yeah.
David F.
In terms of these three questions, I'm okay with the general direction of going with that, with the wrapped and the receipts, as long as they're considered kind of equivalent to whatever it is. Just my only question is when we get to potential consideration of the disclosures and the levels, is if you have a wrapped, say, Bitcoin on, say, 5, and I guess going back to it is, yeah, if you're transferring things in out of wrap status, it is an equivalent. I mean, the only consideration I would give to is like the market and of the platform, the liquidity of whatever sub platform those wrap tokens are sitting in. Because if you go and wrap something and it is on a platform that has difficult liquidity to transfer back, that might be an issue. So I would probably consider liquidity concerns as part of that wrap token status. And then the second comes to disclosures. If there's becoming more platforms and more wrapped statuses, is that disclosure can start wrapping pages. So consideration as to whether or not you want to have like, I don't want to say it, but like a Bitcoin and Bitcoin equivalent for like those wrapped statuses. So like a condensed thing like Bitcoin and wrapped Bitcoin, versus 15 Bitcoins listed out. That would be my thoughts.
Great, thank you.
Appreciate the input there. We will move on now to the second project on the technical agenda, which relates to the classification of certain digital assets as cash equivalents. Cash equivalents are defined as short-term, highly liquid investments that are both readily convertible to known amounts of cash and so near their maturity that they present insignificant risk of changes in value because of changes in interest rates. Cash equivalent classification is elective under current GAAP. However, depending on the terms, conditions, and rights conveyed through certain stablecoin arrangements, some stakeholders responded that a lack of authoritative and consistent accounting guidance has led to uncertainty in stablecoin accounting classification, whether as cash equivalents, intangible assets, financial assets, or possibly as a derivative. Next slide. Based on stakeholder feedback, the board added a project in its October 29, 2025 meeting with the objective of clarifying whether certain digital assets like stablecoins may be classified as cash equivalents and directed the staff to research adding illustrative examples to clarify the application of the current definition to certain digital assets that would or would not qualify, or by revising the definition of cash equivalents. Key characteristics under consideration include the amount and composition of collateral, cash redemption rights, and value stability. Other relevant characteristics may also include compliance with applicable regulatory frameworks. We've included a number of questions for PCC member discussion on the next slide, on this slide. First, how do you see stablecoins or similar digital assets being used by business entities today, and how are they currently classified? Second, do you think there are certain stablecoins or similar digital assets that qualify for classification as cash equivalents? And if so, what are your perspectives on those characteristics that are important to reaching that conclusion? Do you think there are additional disclosures that are needed? And fourth, how should regulatory requirements such as the Genius Act be considered by the board? Lastly, we have a question primarily for users of financial statements about the information that is needed when analyzing a company that uses or holds stablecoins or similar digital assets, and if there are changes to that information that you might need or find useful. I'll pause there for discussion.
David F.
Yeah. And thoughts to your company, or I'm sorry, your questions. On regards to the cash equivalents, I think we definitely need to have a high hurdle aspect on the consideration of that classification. Again, I highly agree with the ability to easily liquidate or convert your stablecoin into a readily convertible cash or cash equivalent, in terms of whatever country's currency it should be in. So I think that should be a high consideration. In terms of value stability, I would be looking at things that aren't an algorithmic stablecoin, and definitely focus on things that are reserve backed for that aspect. So I would agree with that. Some of the things that, as a practitioner, with upcoming ASB activity around confirmation of cash and cash equivalents, I would have some concerns about the auditability of considering those assets to be explicitly a cash or cash equivalent balance from that aspect as well, because I think there's going to be challenges to meet ASB or auditing standards along those lines. And then as well as additional disclosures, since they are, I guess, subject to the ability and whim of an individual and not, I guess, a country, even though you could say a country that's controlled by a dictatorship could be still a currency controlled at the whim of an individual. I just think that significant additional disclosures around the risks, the concentration of risk, more in line with what you're seeing with a restricted cash disclosure in terms of in, outs, balances, etc., should be explicitly disclosed for that stake, because everything in that is at risk that's not backed by a country or something of that type of equivalent, even if it is cash backed. Robert? Oh, somebody had a touch.
I think if you get more than two bankers together, this would be a hot topic of conversation, because this is viewed as an emerging threat to the traditional banking system, because it's a disintermediation of deposits, and it bypasses the banking payment rail. It is being used to settle accounts, so I think in many cases it is cash, because people are accepting that as settlement. I do think that there are different kinds and different classes and different characteristics, and not all are created equal. So I think the hurdle needs to be high, but it needs to be very clear that some are cash and some are not. And I think research is required, and I really think it's an important project for us to think about what that should look like and what it should be, because I think it's here, and I think it's going to be growing pretty rapidly.
Thanks, Robert. Rich?
Yeah, one thing, and I think Jake covered this kind of in his tee up, is we have an existing definition of cash and cash equivalents. And one of the interesting things is if we do nothing, people will look at these instruments and make a determination on whether or not they meet that definition or not. Part of what I think some stakeholders were asking us to do was to help them with how you would apply the existing definition to these types of instruments. So, as we go through this, it'll be interesting. Do we want to change the definition of cash equivalents, either to make it more restrictive or more permissive? But right now, I think really the way the board was headed was, let's understand, here's our definition. Here's what people have to do in practice today. How does that work? And it'll be interesting. The Genius Act, interestingly enough, only defines what can't be a cash equivalent for accounting purposes, but it never says what can be. So in some ways, our definition today might be broader than the Genius Act. In other cases, our definition of cash equivalents today might be narrower than the Genius Act. That is just a recipe for confusion going forward if we don't get in and talk about the application of our definition. I think when Jacob illustrated determining something as a cash equivalent is an accounting policy election. Because the way the Genius Act is written, it says you can't treat them as cash equivalents for accounting purposes. So you'd hope no one would elect an accounting policy election that violated the law. So that'll probably be something else that comes into play here. No matter what we do, someone will still have to consider applicable law when they select their accounting policies. So just as another wrinkle in this.
Holly?
Yeah, I in response to Rich's comments, I don't think we should be changing the definition of cash equivalents. I think, either through, examples that could be codified or educational paper might help to identify these things, because one, it's ever changing, and at least it would provide some guidance without really, impacting the overall codification.
Adam?
It seems like something needs to be added. Maybe it's examples and implementation guidance if we think the existing definition works. That makes sense. It's been interesting trying to think through this, because I actually think more about like what are the sufficiency disclosures, and I try to think about not every stable coin is created equal. Some are going to be fully backed, which is more than we could say other cash equivalents. They're going to be fully backed, and they're going to be government regulated. And I think there's opportunity for other types of stable coins or things that look like stable coins that aren't. And as we adapt accounting standards and disclosures, let's try to make sure investors and anyone looking at the financial statements will get enough information to understand those types of like concentrations and the types of risks associated with these.
Thank you. Anything else?
Nope, that ends our presentation.
Great. And we're right on time, shockingly. And so we're going to take a 10-minute break or 7-minute break. Let's go for 10:55, and we'll see you then. Okay, great. Thanks for coming back. I think there was maybe some question about whether you were going to make it back, but Jennifer's going to lead us through topic 9, and in particular on these topics related to the use of technology. I think the staff hearing from the preparer community about impact technology is having on what you're doing, and the user community and how it affects your reliance or information you'd like in particular. And then practitioners, you guys never hesitate to speak up about what you think. So, and with that intro, Jen, take it away.
Great, thank you. And I think you just did my tee up for me. So, but again, so the objective of this topic is to seek PCC members' input on how technology should be considered by the FASB in standard setting, and how technology is affecting financial statement preparation for private companies and the use of information by private company financial statement users. We do have a series of questions to go through, and we're going to do them one at a time because there are questions and sub-questions. So question one, what should the FASB be aware of or continue to monitor as it considers current and future accounting and disclosure requirements? So for a question for all, given changes in technology and business, is there current accounting guidance that is outdated and should be approved? And then for users, how does technology affect your information needs and your use of information? I'm paraphrasing that. And then for preparers and practitioners, how does technology affect the cost associated with accounting and disclosure? So I'll pause there.
Hey, Doug, go for it.
Putting me on the spot there, Jerry. Thank you. No, you can always call on me. That's a good question. I mean, yes, obviously AI is the biggest topic ever right now, and certainly an area of emergence in terms of how AI and technologies are used for accounting departments, finance departments alike. I think honestly, there's more internal controls related matters, particularly with the use of AI, that come into play than truly standard setting issues. Off the cuff here, and maybe I need to do a little bit more pondering on it. Nothing immediately comes to mind from my perspective on standards that are outdated or things that need to be addressed immediately in the wake of technology. I will say, though, from an internal controls perspective on how companies are using technology to perform tasks and ultimately govern the use of that technology is highly critical. And then I would say maybe outside of the sheer topic of AI, I think just something I'm seeing every day because I am responsible for, the internal controls function at my company, is just the complexity of software and systems integrations within companies, the reliance on tools and technology, whether it's Alteryx or Tableau or these very sophisticated technology solutions to be able to perform functions, taking sort of this human touch element out of things. It places a lot more risk on this over reliance on integrations. And so again, this is more of an internal controls to me related topic on the more that we become sophisticated in the use of technology. I think we have to make sure we've got the right governance in place to be able to use that technology appropriately and to make sure that we're identifying issues in financial reporting or otherwise that would otherwise not be as big of an issue if you weren't utilizing that technology. So unfortunately, I think for the benefit of this group, I don't see anything from a specific standard setting perspective, but those would just be some of my observations from the preparer seat that I'm in.
In the, you're a big company, you're seeing and probably implementing these faster than other places. Do you think the accounting related to this technology and the related software and, the IP you may or may not develop in your own process, do you think current standards are useful for your team and what they do with those things?
Are you specifically asking around the accounting for, say, software? And yeah, I think I was very and still maintain a lot of passion around the accounting for software project. I know where we landed kind of initially on that was for some initial simplifications. I think with the emergence of AI tools, particularly those that are developed in-house by companies, as well as those that are purchased or licensed, will certainly be something we'll need to continue to monitor as it relates to how we account for and disclose software. Do I think right now we're seeing a ton of, yes, we subscribe to Copilot, and so we have the use of certain tools that we pay for, and I think the accounting for those I would say right now is relatively straightforward. I do see, though, that being something that we'll have to continue to monitor as we move forward in terms of how that landscape changes and what that means for the potential changes to the accounting guidance.
Great, thank you. Autumn, how do you see some of these things impacting you and the financial smaller company environment?
Yeah, I would say from my perspective, it's been a slower adoption at a company of my size. And so the thing that I thought of really aligned with what Doug was saying is as larger companies and companies who are developing their own systems, get into this. I think the software component of it is going to be where the standard setting will need to be focused, at least in my opinion. I think otherwise, can't really think of anything standard setting wise that needs to be addressed with the use of AI, at least not from my perspective.
No, I picked on those guys. Robert, do you have any perspective on, how you guys are seeing your clients, and do you think there's any standards that need to evolve?
I think it's still evolving, in my opinion, to the point I don't think we can see standards yet. I think it's something we need to monitor very carefully because I know my sphere that I run in, everybody's still trying to figure it out to some degree and figure out how to use it. And they're a little nervous about it, but I think it's viewed as a really important frontier. But in my opinion, we're still a little early to think about adjusting the accounting for it.
Great. Okay, practitioners, what do you guys think? What are you seeing in your space? Adam?
We're asking the same questions just to start. So, we're certainly asking across the firm and across our client base, are you using it? How are you using it? I'm very concerned about internal controls related to them and garbage in, garbage out, like any system, right? So how are this being verified? That's not specifically an accounting standard. I don't currently see complications with accounting standards. I think what Autumn and Robert said is probably consistent with what we're hearing so far, is it's still trickling down. I know there are products that are going to make things easier, financial reporting easier. When I think about the technology, I actually start thinking more about like the PCDMF and like, are we tracking towards a future where we will be able to level up the sophistication with smaller entities with smaller resources? I think private companies, for example, fair value and harder to accomplish modeling has always been a real problem. And I think about like share-based compensation. A Black-Scholes model was easy enough if you kind of knew what you're doing. It's much easier with some of this technology and at least in kind of that middle market client base, it's a hurdle getting management to make an assertion in which then I can audit in many of these areas of complex accounting. And I think we will get to a point where this might make that a little bit easier. So I don't know in terms of actually like changing these standards, but I do wonder if it starts changing how we think about resources and capabilities of entities by size, and particularly would impact the PCC.
Wow, Adam's trying to get rid of us. Mike Chang.
In terms of current guidance, I know that guidance was just issued, I think, when you're developing AI and whether there's uncertainty on how you should capitalize that. So I think that that's helpful. The questions that I'm getting, which I don't know if it needs clarification, is if you're using AI to program. So right now you've got programs like Replit or Copilot, where before I think developers are actually going in there coding each line of code, whereas now you're prompting and prompting and prompting, and where that's capitalizable. As far as technology and affecting costs and accounting and disclosure, I do think it's going to improve accounting. I think we're going to get more accurate outcomes because we're able to go through more agreements, information, I think better than what we had before. And if you are conceptually sound or understand the accounting guidance, you're going to be able to ask better questions. So I do think we're going to have improved financial reporting, and I do think costs will come down when people learn how to use the software and learn how to validate what AI is providing. But see, no basis for that. It's just my guess.
Rich?
Yeah, I'm just curious. Are you guys getting any costs on the costs associated with training models?
Not that's met my level, but to Mike's point a minute ago on some of the coding, the technology is evolving so quickly. Those costs are quickly moving from really heavy development, kind of machine learning training to, Doug can subscribe to Copilot and just put in some prompts and the model kind of trains itself. Even in the last 12 months, the technology has evolved at a pace that's kind of astounding.
Okay, thanks.
David F.
My comments are similarly aligned with what Mike was saying is if you're using a software to code and create another internally developed software program, possibly consideration there about software development costs, in terms of whether or not you have an internally developed or you're renting or a subscription base that's creating your other internally developed software, if that's going to create any accounting issues going forward as these things become more able and quickly evolve and adapt to start doing that type of information. So that might be something on trigger, but I mean, other than that, I think overall the reduction of cost and complexity of some of the accounting and a little bit more clarity on some of the more difficult issues might be beneficial to us, but nothing that I can think of that would cause us to give consideration.
Great, thank you. Yep.
Okay, question 2. Some of you have already somewhat answered, but I'll go ahead and ask it to see if there's any incremental feedback that you want to provide. And that is for preparers and practitioners, how have investments in technology in the past 3 years changed private companies' preparation of financial statements? For users, how have investments in technology in the past 3 years changed the use of information in private company financial statements? And then for all of you, what investments or changes in technology are expected in the next 3 years? And does the current or expected future state vary significantly across private companies? So I'll pause there to see if anyone has incremental feedback to share.
Adam.
I think we'll have a lot more to tell in the next year or two than we do right now in terms of significant impact in private companies outside of the largest. You were just not quite seeing them, but if you're following what's going on in the accounting software technology space, I mean, there's new vendors popping up every week, it seems, and I think as that market really starts hitting and people start using them, we'll have a different answer than we do today. I think today it's a little too early to tell. I'm not expecting significant changes for this sort of calendar year and cycle.
Thanks. And I think one of the challenges that practitioners face as companies adopt technologies basically made by someone in their basement about whether or not they actually do what they say, which goes to the internal control point. I mean, it's a lot of people promise things, but whether or not they deliver that's more of an auditing and control challenge, and I think it is a principles of accounting issue.
It's very much an auditing concern, is internal control, and then it's actually it's actually harder because the hallucinations are so real with some of this technology, and they're so polished, right? So you really have to be skeptical to try and have to have a decent knowledge base to decipher what is just a really good looking hallucination. I mean, I've seen it make up references and make up codification, and I mean, and so certainly as an auditor, we have our concerns.
Doug?
Yeah, just kind of wanted to reiterate Adam's point, maybe add a little bit more context just on I think we're going to see a lot over the next few years. I can speak specifically for my organization and those others that I've chatted with is we're seeing a lot of momentum in building internal teams around this sort of thing. So whether that be AI councils of cross-functional team members between finance and technology departments, or a variety of those types of things to think very strategically and specifically about those types of investments. I think organizational effectiveness, for companies that really lean heavily into their organizational effectiveness departments, everyone's got this as their top 1 or 2 items is how do we make sure we're leveraging technology and specifically all of these very fast maturing technologies in ways that help amplify organizational effectiveness. So I really do think within the next year or two, we're going to start seeing some specific momentum accelerators start to show up in those types of investments. So I do think we are at an interesting inflection point of, in the next couple years, really starting to see some significant changes in how companies are utilizing these emerging technologies.
Thank you. Others? Go ahead.
Okay. Question 3 is around expected benefits and expected cost and standard setting. So what should the FASB be aware of or do in considering the relationship that technology has with the expected benefits and expected cost of potential future changes in standard setting? We do have some examples that are listed in this question. I'll just briefly go through them. So around cost, does technology allow private companies to create data that are more accessible, higher quality, and more granular? And judgment, how is technology deployed in accounting areas that require significant judgment? And should future accounting and disclosure requirements necessitate less judgment so that the related information can be more easily automated and processed? And then another example is when setting accounting standards, how should the FASB consider expected costs and expected benefits for private companies and users with the most advanced and least advanced technology capabilities?
I think one of the things I'm concerned about is what was alluded to earlier about the accuracy. Seems to make stuff up. And I think there should be some thought around, do we need some sort of disclosures about stuff that AI did so that we may try to test that a little bit more? I don't know. It seems if one of you guys do something, well, if you tell me tomorrow's Easter, I'm gonna go home and color eggs. But if AI's done it, I may need to dig a little deeper. So I'm really worried about the accuracy part and how much we can rely on that, and if we're going to need some disclosures or conversation about, I used AI to do this part, and it might require a different level of inquiry than not. I don't know. I'm confused about that, but I would pose that as a question. I'm really interested in what others may think about that.
So I want to make sure we're clear that I want that in our annual report. Thank you for that, Robert. Adam?
So this is a response to Robert because we've been trying to track this. The problem, I think, with trying to figure out, put a bracket for users of any information of what did AI do is we're quickly moving to a world where it was everything. It was involved in everything. So I don't know how helpful that disclosure is going to be to you, Robert. You should just assume that it was involved somewhere along the process by someone, even when a company says we're not going to use it, they hire somebody out of school and that person's got it on their phone, and you should assume that it was involved somewhere along the process.
David F.
Yeah, I mean, from a risk standpoint, our firm has a policy where we have to include in our documentation if this item was created by AI or calculated or done from that aspect. So we have a clear tracking of it. But like Adam says, is things may start to slip through, things may get a lot more complex, complicated, especially when you get to financial statements. Companies may be using more AI models to take the information and draft those and leave it up to somebody else to evaluate to make sure that hopefully the accuracy and completeness is there, and it more becomes a control process and whatnot over is that information appropriate, and just requires probably more skepticism from the outside on the accuracy and completeness of that information. So yeah.
Thank you.
Okay. Last question is around learning and research. What should the FASB be aware of or do when considering advancements in technology, skills, and education? For example, how is technology being used and taught in academic settings? And how is the codification being used? And how should advances in technology be considered in preparing and maintaining the codification? I'll pause there for feedback.
Brad, I think they wrote that question for you.
Yeah, happy to jump in. This is all consuming at the university level. I think we've seen the University of Utah in recent weeks come out and put a minor in AI out of their business school that's available for any student. And so this isn't just an accounting issue, a business issue. This is university-wide emphasis that is being given to this. In terms, though, of however it's kind of directly, I think, applying to the accounting space. I think this is an area where academics have a lot to contribute to how this is changing the environment. An example of this is some research that came out of Stanford in September. they tried to determine the extent to which AI is being used to create disclosure. And there's a lot of beliefs about whether we're able to detect AI or not, right? And from a teaching standpoint, I don't believe I can detect my students cheating. I don't try. But this work that they've done was really pretty impressive, where they tested a tool on if this was they created themselves or if AI had created it, so they knew the answer. It showed a high ability to detect AI, and then having validated it, they took it into conference calls, annual reports, and such. And what they found was in 2024, 4.5% of new text seems to be attributed to AI. And so you might say 4.5% isn't a lot, but that's a big piece of a financial report that it believes has been crafted by AI. And so there are lots of really smart people working on this, trying to figure out, how much of it is happening, and it's not necessarily bad. Is it creating better disclosure? And I think these are the things that academics are really interested right now. And so, in response to the question, it's taking over a lot of our curriculum, and I think we're all interested in seeing what its capabilities and limitations are. And there's certainly evidence to say that it's being heavily used, and lots of open questions then about what that means.
Mike Chang.
I guess pointing to the second point, it would be nice. I mean, this is kind of a wish for me, to have AI overlay on the codification. And I guess my perspective is if you go on a particular area like share-based payments or business combination, I think one of the things that I always thought about, actually, it could have been a project when I was a staff member too, is if you click on a particular paragraph, what was the source and the basis supporting it? I think that was a heavy lift to make all those connections. But now with AI, I think you could bridge all that much easier. Like you've got the cross-referencing, you could get all the historical knowledge that kind of led up to whatever's in the codification. I think it would also be helpful if you have a transaction where you could ask, what do you think the potential scope is? Not that it's definitive, but just point you in the right area of this is maybe the guidance you'd want to consider. So I think it could be helpful for the public in interpreting GAAP, I guess.
Holly?
Yeah, I was going to talk about that. I think it actually with AI helps, the smaller private company. I mean, you can now kind of go out and do research and get answers. I mean, some of these things we were preparing for in the digital assets, like, okay, I don't even know what this is. So I think that's something that might actually be helpful for private companies. But the concern becomes is it accurately summarizing the codification? Kind of to Robert's point, yeah, you can get this information, but is it accurately doing that? And I don't know how the FASB would be able to actually monitor that, or maybe, as you say, with an AI overlay, maybe that will help, increase the credibility of the searches.
So we could use it to go back and research the ARBs to see whether or not there's something in standard setting from the 50s we want to use, right? Adam?
Yeah, just sharing, at least from the practitioner perspective, these are things we're trying to think through. We're trying to think about what is going to be different in new hires coming out of college, and how are they going to understand, and what is the relationship with the standards and their research skills going to be. It seems certainly at this point that research is going to be a dramatically different approach, and it's not new, right? Some of us used to use card catalogs and get paper, and that's evolved. But at least my understanding is, AI is the first option for many of those folks. And so when you start thinking about the COD, it's a great basis of information. It's right there, ready for AI retrieval. And then I just tend to focus on, well, what skill sets do you need to be able to do that responsibly? How do we make sure we're verifying the outputs and that we're guarding for hallucinations? And that's the part that's kind of developing along with the technology, maybe slower.
Thank you. Christine.
Just wanted to emphasize sort of the challenge with the pace of change, though. So, today we're talking about hallucinations, but there are some studies that argue that state of the arts, the state of the art models today are doubling in their ability to complete tasks and do it more accurately, doubling in their ability every 7 months at this point. So what we worry about today probably won't be worrying about that come July of next year. And that's also a challenge, I think, for education, because how do you stay ahead in what is a relatively slow-moving environment, I have to say, about any educational system, higher ed maybe more so than others, when those improvements are happening so quickly. So another study showed that in 2023, AI was solving about 4% of coding problems. By 2024, it was at 72%. So it's improving very, very rapidly. And I think that's the thing that's going to be really, really challenging, is just how do you stay ahead of those improvements, and how do we know we're focused on the right problems because they may be solved within the next few months, right?
Yeah, and I've thought about this a little bit, and I think I've seen a couple articles about it, what that means then about the obsolescence of technology, and the chips that companies are buying, what actually is the life of this in a world where things are improving so fastly. And so, kind of related to us. But yeah, to Christine's point, I am on a study from 2003 where we ran all of our exams through ChatGPT, and we found it got 56% right, which was absolutely awful. The next year, it's passing the CPA exam and CMA and everything else. So the pace of change is amazing in its ability to pick up accounting issues specifically, and I don't have any reason to think that it won't just continue to be of higher use.
Hey, let's be optimistic about how that'll turn out. Okay, that's it. Thank you. All right, we're on to topic 11, and they are raring to go. Take it away.
Thanks, Chair. Good morning, everyone. In connection with our ongoing post-implementation review of topic 326, or CECL, we're asking the PCC for any feedback on the benefits or costs of implementing and applying the standard. I'm going to briefly summarize the memo in your meeting materials to provide some background, and then we have 3 discussion questions at the end. The CECL guidance was issued in update 2016-13. It was effective for public companies in 2020 and private companies in 2023. Prior to CECL, financial instruments accounted for under U.S. GAAP followed an incurred loss model, meaning credit impairment was recognized in the financial statements when the loss was incurred, a threshold defined as probable and reasonably estimable. Following the 2007 global financial crisis, the incurred loss model was criticized for delaying the financial statement recognition of losses that were expected by creditors and investors. The current expected credit loss model, or CECL, was developed to address those shortcomings, primarily by eliminating the threshold for recognition of credit losses. Instead, financial assets are carried at their amortized cost basis with a separately presented allowance for credit losses. The allowance reflects the current period estimate of the amount not expected to be collected, which a creditor must develop using information related to past events, current conditions, and reasonable and supportable forecasts. As measurement guidance, CECL is applicable to financial assets upon initial recognition, such that the amortized cost basis, net of allowance, will equal the amount expected to be collected as of each balance sheet date over the life of the asset. The post-implementation review began immediately upon the issuance of Update 2016-13. The board initially monitored implementation through review of financial statements and the formation of a transition resource group to address practice issues in real time. Additional feedback has been gathered through direct outreach to stakeholders, surveys, educational workshops, technical inquiries, and public roundtables in 2019 and 2021. Today, the board has issued 4 ASUs to improve or clarify Topic 326 because of that feedback. However, the PAR process remains ongoing, and we continue to solicit feedback to evaluate the effectiveness of CECL. So with that, unless there are any questions on the memo that was distributed, I'll pass it back to Gia or Jennifer for questions 1, 2, and 3.
Want to read them?
Yeah, question 1 asks, do PCC members believe the CECL standard achieved the expected benefits for financial statement users? Do PCC members have additional observations to share on what information on credit losses is being used or not used, and how is it being used? I'm going to read the next question. Okay. Question 2, do PCC members have additional observations to share on the initial and ongoing costs to comply with CECL? And if so, please describe the nature of those costs.
Great, thank you. David F.
We are seeing some benefits as a practitioner on the use of CECL. There's still a little, and the ASU that was put out earlier this year was significantly helpful to private companies. So there's a lot of thanks and appreciation for that being published and being available. In terms of CECL for private companies, it still ends up being a year-over-year kind of readoption for a lot of companies because they don't really consider it as part of their interim process because most of them are really just focused on their year end. So there is still some work, especially around the disclosure of the changes in the CECL reserve as it applies to revenue recognition and actual changes that should be applied throughout the year. So some companies we have seen some issues where companies may try to shortcut that and really haven't been asked follow-up questions from outside users on that information being relevant or applicable to them. They're more focused about the risk that exists as of whatever the measurement date is versus, an interim period, how much CECL was initially recognized as a transaction, say under 606 occurred versus what was released under that same transaction because there really wasn't an actual change. So that's kind of an area where we're seeing a little bit of, I think error to continue along that ways. And not as much relevant, useful information for those for private companies, especially, given such the long time gap between those that it takes time, cost, complexity to pull that together, which may not provide true value to a user, but I might want the users to contribute their thoughts on that too.
And Robert has his hand up.
I really think CECL has been very effective in shifting the dialogue in banking. Historically, banks looked and said, this is what's happened in the past, so let's be prepared for that to happen again. CECL has required the industry to look forward and said, if different things happen in the future, what will be the effect of the losses in the loan portfolio? So I think it's had a very positive long-term impact on the banking business. Now, there's a lot of old gray hairs out there that will never get over the change from the historical loss model, and they'll hate it until they retire. But I think it has been a really healthy change to the industry and caused it to be more forward-looking and being able to think about contingency planning that could result from different scenarios unfolding. Now, I don't know, the number is still a good number, but I really think it shifted the dialogue, and I think CECL has been a very positive thing that, and I applaud FASB for staying with it and seeing it through to the end.
All right, a couple of very positive elements of feedback there. Other comments or questions for the team? All right, early bird gets the worm. You're in and out.
Thank you, everyone.
Topic 11, we have the fast-paced update from Nellie on issued and forthcoming accounting standards.
Yes, and in this case, actually all issued, the ones we have to talk today. So thank you. Hello again. I have a few documents to discuss with you that have all been issued within the past few weeks. We'll keep these on the brief side in particular today. We've talked about these with the PCC before. As always, we share these updates with the PCC to make sure you all are familiar with where we're landing. We know you provide feedback along the way. We want you to see how that's been reflected in where we're landing on these different projects. And we really appreciate all the perspectives that you share to shape these projects as the board undertakes them. So the first one to talk about, update 2025-08 on purchase loans, which we all still call PFA from a previous title, but this is continuing with the CECL theme. This guidance was issued in November. We did discuss this project with the PCC in 2023, but it's been a while, and the board made a couple of changes to the project in redeliberation, so I'll start from the beginning. But under the CECL model in an acquisition, there are two categories for acquired financial assets: PCD accounting and non-PCD accounting. And at a high level, PCD loans or PCD assets have more than insignificant deterioration in credit quality since origination, and they're accounted for under what's called a gross-up approach, where the allowance for credit losses is recognized with an offset to the amount of the loan. Non-PCD assets, on the other side, the allowance is recognized through the P&L at the time of the acquisition. And we've heard feedback pretty consistently since CECL was issued that non-PCD piece of the accounting doesn't make a lot of sense. It's double counting the expected credit losses that were already incorporated into the fair value measurement or the determination of the acquisition. So what this update does is expand the population of assets and loans specifically that are accounted for using the gross-up approach. So loans excluding credit cards that are acquired without credit deterioration that are deemed seasoned are treated as purchase seasoned loans and accounted for using that gross-up approach. That's a very high level discussion of this. We're happy to talk if you have more questions, if there's more we want to cover on this. I personally just hope Robert is happy with these changes. But that's what we have to say on purchase loans. The next one I want to talk about, continuing with financial instruments, was update 2025-09 on hedge accounting improvements. This was also issued in November. It's got 5 separate issues in it. We gave the PCC a brief update on this project in 2024. I just want to say the issues that we're dealing with in this hedging project came up for a few different reasons. First, there were some bigger changes to hedge accounting in 2017, and in a few of those cases, the improvements didn't quite get effectuated in the way the board was intending. So some of these are following up on those changes from update 2017-12 a few years ago, and some of those were exposed, I think it was 2019. And then a few of the other changes are related to the cessation of LIBOR and the change in reference rates. So a couple of the other changes to hedge accounting are necessitated by that ongoing LIBOR cessation. In the interest of time, I'm not going to go through all 5 of the updates that are in the hedge accounting, but I want to briefly mention that there's one that may be relevant to some private companies that aren't banks in particular, which is the application of hedge accounting to a specific type of debt instrument that we often call choose your rate debt. You pick 'em debt as well, intending to allow the instrument allows the borrower to change its interest rate. And the amendments are intended to simplify the application of hedge accounting to those instruments or for those types of instruments. We're hopeful that these are useful updates to hedge accounting. This is effective for calendar year and private companies in 2028. The next one I want to briefly mention is government grants. That was issued earlier this month. We discussed government grants with you all in June. We talked a little bit about the presentation requirements. We talked a little bit about the approach of starting with IAS 20 in those meetings. So I'm not going to recap everything that we talked about for government grants, but just the board's intent with issuing this guidance is to improve consistency, that since there's no guidance at all on government grants to business entities today. The accounting for that is done by analogy, and therefore accounting models applied by analogy could be different from entity to entity. So it's hoping to narrow that diversity in practice. And we did mention the board decided to leverage IAS 20 from the IASB. We made a few changes to the scope, to a couple of the provisions for how that works to make it more workable. IAS 20 is pretty old guidance, but we did start with that model. We can talk more about that or go through other questions, but since we talked about that relatively recently, I'll leave it there. And last but not least, we earlier this week, we issued our guidance on interim reporting. We've talked about this with the PCC a few times, most recently, again in June. At that point, we talked a little bit about kind of the objective of this guidance, but I'm just going to, as a reminder, highlight a couple of things. The reason for undertaking this project is that the guidance that was on interim reporting in the codification before we did this was old, badly organized, difficult to follow. We had trouble even understanding for ourselves what was intended to be an interim reporting requirement and what wasn't. But let me emphasize three things about this. First, the guidance clarifies the scope of what types of interim reporting we're talking about here. And we've got it defined as interim financial statements and notes in accordance with GAAP, which we think about as condensed statements, limited notes, maybe both, but that includes financial statements. So a private company that provides a balance sheet to their lender at an interim period is likely not in the definition of interim financial statements and notes in accordance with GAAP, and therefore this guidance would not be targeting that type of reporting. But for entities that do provide interim financial statements and notes in accordance with GAAP, we're trying to clarify how we think about that. I will emphasize, while we're clarifying how to think about that, the board was not intending to change the overall level of disclosure at an interim period, or was not intending to change the fact that we think about interim periods as an update to annual periods. It's just to clarify, reaffirm that understanding of interim reporting, clarify what's required and when. We did make other changes to improve the navigability of the interim requirements in Topic 270, more clearly identify what are interim disclosure requirements, so we can talk more about those if we need to. That's everything I wanted to cover.
Thank you for that hot flash.
Yeah.
Any questions or comments about Nellie's comments? Great. So we're coming to the conclusion of today's meetings. First, I want to acknowledge Rick Reisig, who's on the phone, who's been our FAF liaison for probably his whole 5-year term. Is that how long it's been? And previously to that, he was on the PCC. So he was active in recruiting me to come. And so I very much appreciate that. So thank you, Rick. And last but not least is I've only been talking about Holly retiring for the whole time I've been here. And she's like, when am I retiring? And unfortunately, today is the day. So I want to thank you for 6 years of service. Your counsel and advice has been valuable to me. And I know we've all loved hearing your stories and your travel travails and hope you have safe water in Sarasota. Round of applause for
It's been a pleasure.
And with that, we're adjourned until March 3rd, when we'll have our first meeting of 26, which will be virtual. So see you on Zoom.